All right, event trader here. Going to be joined shortly with Brett Manning, chart trader, of course. Brett, is that you here piling in right now?
Yep, here I am.
How are you feeling today?
Doing all right,
Uh,
Stiff upper lip.
that's good. Stiff upper lip's always good, and of course, I'd be remiss not to wish you a happy New Year. I think this is the first time we're talking in 2019. But
You too, Gav.
Oh, thank you, thank you. Hey, so I know you were pretty busy over the holiday season there, talking about how good of a trading environment it was. Seems like I should just go on vacation to help out your trading all the time there, Brett. Right? It's just
I think we need to invest in sending you away, Gav.
I'm down with that investment.
That was some. I think it's a win-win. That was some spectacular market action over the last 10 sessions or so of the year. Really kind of rounded out the year nicely.
Yeah, I swear to God, every time I go on vacation, there's just volatility just kicks right in. So it's pretty annoying to watch sometimes. But with that in mind, Brett, what did you think of, I guess, the posts? Obviously, we had that big selling on Christmas Eve, and then we had the bounce back on the following days. I think it's 4 days in a row for the NASDAQ being up. And just kind of curious as to your take overall on what you saw and how meaningful, given the time frame and participation, do you think any of the action was around that time period?
Well, I mean, it all really starts with the sense that we reached an extraordinary set of bearish extremes in sentiment when we got to those lows, especially on, by the time we came into Christmas Day, I think we had true extremes in the AAII, the Robo ratio, the Lobo ratio, the equity hedging index, the 10-day put call ratio, inverse ETF volume, the VIX futures term structure, which is big, which is the difference between the 1 and 3 month where the VIX futures are. Right. When that moves to backwardation is really rare, and it's in line with all these other signs of just really kitchen sink level hedging of everything. And one other thing that I noted as well was I think we had the high, the intraday high on the VIX crossed above its daily upper Bollinger Band on 7 straight days, all of which had the VIX above 20. And I believe that's the first time that's ever happened. It didn't even happen in 2008. So it's just kind of, every day for 7 straight days with the VIX above 20, with the VIX spiking at some point during the day.
Do you see that as a relativity move? Like, so in 2008, I guess everybody knew everything was so bad that, it just wasn't, you didn't get that spike in activity as much as just like a consistent downswing, where here, things are used to so little volatility that all of a sudden when you had that pickup in volatility, things got a little bit more extreme, a little bit quicker. Would you say that's basically?
I think the comparisons in 2008, yeah, I mean, there people understood more about what was happening when it really started to go off the cliff, like post-Lehman.
Right.
We had a series of crash days, but they were interspersed with consolidation days where volatility calmed down and then it would crash again, and volatility calmed down and then it would crash again. And this was just 7 straight days of just kind of, the bid just getting hammered away. And that brought us down to the lows that we saw on, I guess, Christmas Day in the futures may have been the low of record. I think that's right. But that, at that point, to have such an extraordinarily skewed tape, yeah, that's right. Christmas Day in the futures, around 23.15 or so. That kind of set the tone for the following week, and that was really the beautiful week. Last week, we got the big rally. I went long, and then I scratched out a trade that would have been an enormous trade long the NASDAQ. But then the following day, Thursday of last week, was just tremendous two-way tape where we got a pullback inside of that. We puked people out who'd been sitting in it, and then we ripped again for the final hour and a half or so, 4 or 5%. And we just had a lot of great two-way action. A sequence of 3 days where there was a ton of tremendous trading opportunities, and it was a big payoff for me. And that kind of brings me into this week feeling like, we've had a situation for the last several years where the new year kicks off, and it really you just see completely different feel to the tape the second you get past New Year's, and it can go in either direction, but it just becomes, it's like you've got an entirely different team playing on the field suddenly. And this morning I started it off with what I believed was a nicely falsifiable setup. Short the Dow futures. Dow was lagging, NASDAQ was leading to the upside, and it was really just kind of almost like a testing trade to see if the music was still going to be playing that same way. Because if the music was still going to be playing the way that it was last week, I think we would have pushed down and retested the overnight lows, and maybe in the S&P we would have retested that 2450 level before maybe seeing the rally. But instead we just kind of grinded up through. Stop me out, relatively small loss, 50 ticks in the Dow, which is not a big deal. And when I got out, I said, I think I posted something along the lines of, this feels like a particularly strong kind of bid that seems to be coming into play. And I almost tried to flip sides, but it was tough to find where I put my stop on anything. How deep a pullback is too deep at that point when you start to feel like that bid is coming in. So we're grinding higher. It doesn't feel like two-way action. It doesn't feel like the same kind of fast and loose tape. It feels to me a little bit like day traders keep trying to fade a tape where there's institutional money gradually just kind of, coming in like a faucet is on right now. So I feel like we were seeing a dramatic change in the underlying feel of the tape as we start the new year. But I want to see some more. I want to see some more action to get firm on that.
Okay, just a heads up, we'll keep an eye out for this while I'm talking with Brett, but there's President Trump's talking right now. This is ahead of a meeting with congressional leaders about the government shutdown, just saying that he will work with Democrats, noting that 2019 could be controversial and tough. So with that 2019 statement, Brett, let me ask you this.
What was this? What was the, sorry, was there a headline?
Yeah, he's talking right now, and nothing meaningful. He just said that he will work with Democrats, and just saying that 2019 could be controversial and tough.
That's what he said. Controversial and tough.
Yes. So I don't know.
Of course, it's gonna be controversial. I mean, are you kidding me?
Yeah.
All right.
And tough, I think, is basically what everybody's been saying. I don't know if he's making reference to Mueller or the Mueller investigation or what have you, but we'll continue.
I think probably his negotiating style is that he's going to be willing to be tough.
Yeah. So,
I mean, we don't think I'm going to give anything up here, something like that.
Right. But I'm also saying that he is willing to work with Democrats. And there was a few things on infrastructure that I thought were of interest this morning, but it's still far too early. Let's see him get the government back up and running before we start talking anything about any infrastructure plans at all or anything along those lines. But I just want to make people aware that there is a little bit of headline risk, I suppose, out there with the president speaking. So just something to keep in mind.
Let me just fill in. I would say... guys out there trading, hope that he says something really
negative,
inflammatory. Yeah, because then you buy that, and that's going to be a nice trade. So hopefully he gives that, because then you got a falsifiable setup. It just, slam it down on something inflammatory from the president inside of this tape, the tape that I just described, which I still see as kind of a faucet is on right now of bids. I don't know how long it's going to last, but it feels like it's going to last at least through the day.
So a slam down here would have you buy.
If you get a headline that forces it back down, that's a gimme on the long side.
Yeah, I would definitely agree with that take. So what are some of the headlines in the early action you'll be looking for, Brett, in 2019 as we kick off the year? Certainly a busy start for this week. I don't know how much participation we'll get, but we got a key jobs number coming out. We got that ISM manufacturing number, and then Fed Chair Jerome Powell is sitting on a panel with, I believe, I don't know if I haven't seen, is Bernanke and Yellen on that as well?
You'd know better than me, but isn't that the case, right?
I believe so. I have yet to
I
take
thought that was the word that he was
Well, it's a Fed chair
keep up with
panel,
it.
so I mean that kind of limits the amount of people that could be on that panel, right?
Yeah,
So they're not allowing us on a Fed chair panel. But we'll double check, but I'm pretty sure it's him, Yellen, and Bernanke. And I'd be really curious to see commentary from the three cumulative there, because I still think it was hysterical when Janet Yellen was talking about corporate debt being a big key issue, considering that she kept the rates down for as long as she did. But you got to figure there's going to be a lot about the Fed independence being mentioned within that conversation.
That's the one, yes.
And then I don't know. I mean, because you got to figure Bernanke and Yellen really don't want to step too much on Powell's shoes in terms of the balance sheet unwind and the direction for rates in 2019. But certainly there'll be a lot of tricky questions being asked that I'll be curious to see the interaction between the three. I believe Powell and Yellen have a very good relationship. I have no idea if Powell and Bernanke do, but I believe Powell was nominated originally to a government position under Bernanke. So just something to watch for Friday. And I guess the key is, do we get the December 19th Powell following the decision, or do we get the December 21st Williams 2 days later when he tried to ease concerns about the markets? What do you think?
I mean, I think we're going to get something kind of on the line between the two. But I would say that to me, the drama that nobody seems to really be directly talking about that I feel like is there is, let's just live in the imaginary universe. You've got to think about the probability pie. So let's take a look at this. There's maybe a small slice of that pie where somehow either he resigns or is fired. Let's say Powell is gone. It's a small slice, but the way this has gone so far for him, what happens to the candidate pool for a replacement?
Well, I mean, the problem is I don't think he can.
Who's going to take that job?
Well, nobody, and anybody who does is just going to be viewed as a yes man, right?
What happens to markets under those conditions?
Yes person, I should say.
Yes person. But you're going to have a de facto Fed president named Donald Trump.
Yeah.
And what is that world like? What happens to
0%? I mean, you figure, right?
Well, it's 0%, but it's also the loss of confidence in a process that's going to be, literally trillions of dollars hanging in the balance one way or the other over that term. And
certainly, I mean,
I don't think you're going to get a lot of risk premium in asset pricing under those conditions, personally.
No.
Just the idea that, fine, maybe people want the car to go faster, but they want somebody to be behind the wheel who knows how to drive.
Right.
And it just seems like a bad situation to me.
I don't see it as being a viable ending.
Right. So do we look at the situation and say, well, that means everybody's aware of this, both Powell and Trump are aware of this, even though neither one would say anything about it, and therefore that means that Powell doesn't have to worry? Or is this, I mean, you could think that that's the way that a rational universe would work, but you're not sure whether this one is that. And who knows? I mean, I feel like that drama has been a part of the way the market's been behaving, even though it seems to be not discussed. So I don't know. I just feel like that's the interesting thing. If you've got a Fed chair panel and there's a Q&A, I don't see how this doesn't become all about Fed independence, even if people don't want it to as it starts. So it's going to be interesting to see where we get to there, because I understand that historically there's been some times when presidents have kind of tactfully, behind closed doors, exhibited some kind of lean.
Sure.
On Fed chairs.
But back all the way to Lyndon Baines Johnson for that. So.
Yeah, right. But he didn't have. I mean, I would say he
wasn't doing it on Twitter.
The @real Donald Trump Twitter feed is arguably the media company with the widest scope and distribution in the world, and because it gets picked up by everything else. So you've got all of his followers, plus it gets picked up and put a broadcast across every other media outlet on the planet. So when you publicly shame somebody over that type of medium, that's a tough thing to suggest is just like a private communication. That is, you're bringing in an audience of at least 1 billion people as you publicly shame someone. So I would say doing that is pulling a lever in an important way, And I don't see how you cannot address that, especially when you've got Yellen and Bernanke there, and people are probably trying to figure out what the situation is right now. So I guess commentary around that point and where Jerome Powell is, and how he feels about that situation. He's probably going to be tough to get anything out of that way, but it seems like that's what people are going to want to sense. And as far as how could he not at least give a little bit more of a credence to,
volatility in the markets.
I mean, after
similar to what we saw
the Fed
from Williams.
meeting, which we saw from Williams. So I would assume that there will be at least a little bit of a nod. What we were looking for on Fed Day last time around was just at least the statement of, we've got our eyes on markets, financial conditions are important, and we stand at the ready should there be a major deterioration in financial conditions to provide necessary liquidity or whatever. Something along those lines would seem to be, it's not saying you're going to do it, it's just saying that you understand that there is such a thing as an expectation there of some kind of, the Fed put, and at least giving lip service to the idea that you understand financial conditions are a part of a potential feedback loop that could go in the wrong direction or maybe going in the wrong direction, and just preserving confidence that there is somebody at the wheel. That's your job. That's part of your job. So I would think that we would see some kind of mention in that direction.
Will there be any mention of sugar in the ETF Daily Notes headline for Friday morning?
There was no sugar the other day. Right? So,
there was definitely no sugar the other day.
Yeah, I was expecting some sugar. No, I don't know. So I guess, I would assume that there's going to be, Fed Fund futures are now, where are we on Fed Fund futures for next year by December? Let's see here.
I have not double-checked that, but from my understanding, we're still in the two.
On Fed Funds, no, we're flat.
The
dots were 2, the funds were flat.
The funds are flat now, okay.
Yeah, through December of next year, there's no hikes.
Okay.
Yeah, in fact, there was one day...
There was one time where there was an actual cut, right, in 2020?
And
First quarter in 2020?
So January has a cut leading a hike, but still flat being number one. So... We are leaning toward no hikes next year, and from there, looking ahead, that we have seen the last hike of the cycle, and that we would be heading toward cuts after that, which makes sense to me personally.
So we got the Fed obviously in mind there. Trade is another key factor moving into the early 2019. Here we got that 90-day delay on the tariffs. We've got meetings starting off next week. Now you kind of addressed some of your thoughts around China this morning in your morning thoughts. A lot of people were looking at that manufacturing PMI numbers as the reason behind the weakness. I thought that was a little silly considering we already had a sub 50 read from China on Sunday night, yet we were able to rip. But you kind of discussed it in two parts, Brett, right? You had the numbers and the reaction was possibly the market sniffing out an exportation of deflationary forces from China in the form of justifiable devaluation of the renminbi, or two, a China unwilling to stimulate during the 90-day trade negotiation window. There's been widespread speculation that that a strength-based FX management philosophy was written into the terms of what China needed to do to show it was entering the 90-day window in good faith. You want to explain to the subs what you mean by this and why you'd be focusing in on the renminbi moving forward?
Yeah, so if you see a reinforcement of the idea that manufacturing is contracting in China, look at copper is heading to multi-month lows. We got a secondary data point that basically says, there's a contraction happening now in China manufacturing. That would normally be followed in this situation, I would think, by either currency devaluation or some other form of stimulus that would probably lead to a devaluation of the currency. But I've seen a lot of different talk that, and Stephen Mnuchin was one of the main ones who put it explicitly, I can't remember whether that was like on CNBC or something, where he said you can bet that there will be, the idea that China can no longer devalue its currency will be part of this deal in some way. And I've heard other discussions suggest that that there may be a kind of problem for China in making that move anytime during this 90-day window, or it's seen, and I'm not sure this is how they're approaching it. So there's kind of this common knowledge game going on, where the market is moving according to what it believes other people believe, right? So who knows what the truth of the matter is, but I can see it being a situation where the market is willing to pretty quickly run with the idea that China may have sort of a hands-tied situation when it comes to stimulus right now. So if you combine a reinforcing data point around a contracting manufacturing sector with the idea that they really can't stimulate until, after March, you kind of, that data becomes more important. You see what I'm saying? So
yeah.
their hands are tied as far as making this negotiation go with the United States. I personally am not sure that's true. I can just understand it as a narrative that the market may be buying it.
Yeah, that'd be tough to figure out exactly how that would play out. I mean, just whether or not China would withhold and allow more pain on its economy in order to appease the administration for a 3-month period. It'll be something to watch, certainly. I don't see the Chinese government working in that, but from the renminbi aspect of trying to keep that pegged around that 680 level or something, that could certainly make a lot of sense.
Right. So if they have to do that and they're heading into a further contraction, it could be greater weakness, and you see it maybe showing up in copper and in the Australian dollar and things like that.
Is there any particular levels in the renminbi that you'd be following closely? I mean, obviously a lot of people have been talking about the 7 psych level, but we still haven't tested that, and that was even at some of the lowest when the debates were going around for trade talks. Do you have any certain areas that you're watching for that might be a red flag that could get you shorting in indices, or nothing of mind? You're just kind of watching it and trying to figure out what the trend is.
No, right. I mean, I think that you can kind of look at that chart and see a slope support across the last roughly since October, and see whether or not it's able to break under that in terms of from its perspective. But they haven't really been clearly devaluing very much at all over the past couple months. And if we're heading into a contracting kind of period where we start to see more definite signs from China of a more manifest weakening, then I guess what I would say is, so far, we're not seeing a ramping of stimulus there, and we're not seeing any kind of overt acceleration in devaluation. But we are seeing, like I said, new multi-month lows in copper and the Australian dollar. So it's showing up in other ways, perhaps. And the Shanghai is almost at new trend lows. I mean, it's just banging right into that low right now. If you look at that, if you look at the Dow Jones Shanghai Index, for instance, the 340 level was the low. It's kind of banging right into that right now. So Chinese equities, copper, and the Australian dollar are all heading in the direction of or at multi-month lows without the renminbi losing ground. So there's a little bit of observational evidence there to suggest that maybe they are being a little more cautious about trying to add more complexity to this negotiation. But personally, I circle back around and I say I still believe, I haven't seen any evidence, nothing so far, that China actually wants a deal. And, I kind of see them managing this process, managing it, stringing it along, continuing to offer up little hopeful signals here and there without offering up any major concessions, and just trying to buy time. And I would guess that is buying time with the idea that eventually this administration will be out of the White House and their problems will be over from that standpoint. Now, I'm not sure that's going to be true, because I think that people are starting, as they lift the lid on this, to more and more get a sense that there's some genuine issues there.
Yeah, and I mean, you see some of the other nations' responses to Huawei and things of that nature. And I mean, I don't think everybody agrees with the tariffs, but it does seem to be a cross-aisle agreement that something needs to be done. So I would agree with your take on that. So give me a best and worst case scenario in terms of trade talks that you see over the next 2 to 3 weeks.
I mean, I feel like I can write the script, and we'll see if I'm wrong, but I would say we're going to see lots of big thumbs-up tweets from President Trump about how great it's going, and ultimately it won't lead to a deal.
Yeah, yeah, I would agree with that. Do you think that they could just continue to kick the can down the road with tariffs? Increasing them, or do you think that
that's going to be real interesting to see?
Yeah, yeah. I guess it depends on how much progress we make, right?
Yeah, and also what mood Trump is in. I mean, there's a mercurial president.
Yeah,
he can seemingly emotionally vacillate, and if there's a day when they say no, that he's inclined to be upset at that idea, then maybe suddenly we'll see the next round of tariffs hit. Maybe not. I don't know. But I feel like China, their approach seems to be relatively predictable to me at this point. I haven't seen any evidence to push back against the view that they really don't want to make any major concessions, but they want to consistently string this process along and make it seem as if they are going to pretty soon.
Yeah, I'd agree with that. So let's jump subjects here a little bit. We're about a week away from getting a pretty busy pre-announcement season, 2 weeks away from starting to get some of those bank earnings. What are going to be some of the key things you're going to be looking for in this upcoming earnings season?
I mean, as usual, I will be looking for how the tape handles things more than what the actual things are, to understand what phase of trend that we're in. Going back to mid-November, my process was all about assuming that we would have some kind of grinding, what I think I called a fake bounce to you when we were chatting one day, right, into the end of the year, and then dive in front of earnings season. And as it turns out, the dive came before that, over the last few weeks. But earnings season, I guess the banks are going to be really important. Understand what their exposure levels are, particularly internationally. We got a little bit of a dollar liquidity squeeze kind of environment. And you've got a lot of dollar-denominated debt that's outside of the United States, where when you get into a dollar liquidity squeeze, that becomes where the problem is. And so I guess understanding exposure there would be important. Obviously, European banks have been in quite a bit more trouble.
Yeah, do you have any thoughts on the ECB taking over that one bank this morning?
No, I mean, it seems like it's kind of, I wouldn't have predicted it specifically, but, it wasn't probably too much of a stretch to see it fitting into the narrative that we've seen gradually develop there. Yeah. I don't know. Yeah, that's why probably we've seen the snapback we have at this point, that it's a scary development maybe, but it doesn't really feel too much like it adds new information to the situation.
Right.
So.
Okay.
What are your thoughts there?
I'm not overly concerned with it. I mean, certainly, what I was looking at, and I know I was talking with Andrew, and it seemed like, because one of the things that was keeping, getting my attention this morning was that pop in the German bonds, right, which is obviously a risk-off trade. And then when I started seeing the news about the ECB taking over that Italian bank for administration purposes, Andrew did a quick check on the match up the timing. Now, Germany, we had been selling it off about 2 hours before that announcement came. Whether or not some people knew about it or not certainly remains to be seen. But what I think more than anything is that in order for the markets to settle and for us to start moving higher with any meaningful push is to see these financials settle, and for either this Deutsche Bank issue to come to a head, or for some sort of easing of fear around the European financial balance sheets that certainly seems to be out there. Just watching the euro kind of dropping precipitously here, that's always going to drive the dollar a little bit higher given that basket of currencies. So I think these are all things that need to be settled before we see that next leg higher. So I'm curious to see whether or not this helps ease fears or it just stokes them a little bit further. And until we get past that point, I don't see us really being able to break back towards the 2018 highs is kind of how I'm looking at it. And I mean, just when I was going through putting a list of names together while I was on vacation, just looking at the valuations and how cheap some of these U.S. financials are, even when like a Bank of America that doesn't have as much exposure to the international site, but certainly the Goldmans of the world, the Citigroups of the world, they are just so cheap right now, and that just has me thinking that there's a little bit more fear around what's going on out in particularly Europe and some counterparty risks. So from my point of view, I think it's good that the ECB is taking some steps here, but I just don't really see us being able to push through meaningfully higher until we get that financial situation settled.
I wonder if there's a little bit of like a PTSD situation. I mean,
from the 2008?
Well, I mean, you talk about banks looking cheap.
Yeah.
And that's one of two realities, right? That's either that they are cheap or that there's a lot of stuff that's being poorly accounted for. You know what I mean?
Yeah.
Like they may not be cheap.
But
the real value of assets is underneath the surface, and it just...
Well, again, and I completely agree with that. It's the question is, are these cheap or is there something a little bit more at
so
play here?
It could be, right, and then, the PTSD idea would be that people are, since 2008 happened, they're more willing to start to look at the possibility that there's going to be a massive revaluation of the value of certain assets that would suddenly make them seem expensive at current levels. And so maybe that's wrong, in other words. Maybe there's a psychological predisposition to jump the gun on those sorts of assumptions now that we've been through this process and we saw in 2008 a situation where they looked so tremendously attractive, and then they went off another cliff, and then all their assets were written down massively.
Right,
and we had a completely different reality.
And that's certainly one of the aspects that I'll be looking for, and I think that's kind of what I think for earnings season is the most important aspect is,
right.
Do we get, and we saw it in Micron, we saw it in Federal Express right before the break, right, where they drastically lowered their guidance. And do we start seeing that coming across from a lot of companies? And again, how do they react? Like Micron, I think, has held up relatively well. All things considered. Now they should have another poor quarter in Q1. Early demand is that DRAM's going to remain weak. And I think that we're going to see a lot of cautious guidance coming out. And that's the thing that I'm looking for the most in earnings. And how do we react to that? And the banks could certainly be involved there. Do they start seeing some of their non-performing assets ticking higher? Because all throughout this, we have yet to see how banks react to credit costs moving higher, because they simply haven't as really for 5-6 years. But that could certainly be in play, and I just think that that's the big issue that is facing a lot of the markets in earnings, and I think it's tough to get overly aggressive in front of that.
I would agree with that.
So, Brett, let's talk real quick then about oil. Obviously, seen a pretty big move here. I've seen a lot of commentary about a slowdown in production in Saudi Arabia. Now we're getting the Wall Street Journal story that's crossing the wires with regards to shale wells in the U.S. Drilling a little bit less than what people had thought. So certainly it looks like a attempt to quell some of the oversupply concerns that we've seen out on the market. Obviously, global economic data suggests a continued slowdown in demand there. But what do you think is the bigger story in crude? Is it the demand side or the supply side here at the moment?
I think it's the hedges.
The hedges, okay.
I think it's the hedges. I think there's this mystery, and I've talked with a few people about it. I mean, as far as I understand, and the research that I've done and read suggests that, for most of the U.S. shale space, the median kind of break-even point for WTI is around $52 to $54 a barrel. And, anything below that would mean, without any hedges, they're losing money on the next marginal pull from the ground. And the question is, so we saw data maybe a year and a half ago that a lot of these guys had put in place hedges that were out in the futures market out up the curve to like 2023, basically selling full production in the futures at a profitable level, barely. And that's a natural response to the crisis that we went through.
Would that be
in
done out of
2015.
fear of oil prices skyrocketing in the coming years, do you think?
No. It's the other way. It's they as soon, in other words, as soon as oil got above the break even, as soon as oil in the futures market was trading at a level where that price would be profitable based on their cost of production, they started to sell futures contracts so that they were locking in profits on future oil that they were going to pull out of the ground. So they could guarantee that 2019 would be profitable, no matter what the price did, because they just saw oil at $26 a barrel. And for a lot of these guys, that was going out of business time. And a lot of them went out of business. We had a lot of bankruptcies in the space, right? And so as soon as the survivors saw the price get to profitable levels, they started to sell like crazy in the futures markets out for years. And so they've got these short contracts in the futures, and they've got the oil in the ground, and the two of them add up to profits. So now they can go ahead and pump away and run operations because they've already sold that oil. See what I'm saying?
Right.
Right. They just hold those contracts until they expire, and they deliver the oil from the ground.
But they would need to
them.
pump within that contract to a certain degree, right? They couldn't just
they just pump normally.
Yeah.
They just pump normally, and that oil's already been sold at a profit. It's like they already guaranteed themselves a small profit on that oil. So one of the things that I was looking at is, hey, over the past year and a half or so, is what happens when oil's at 75? Are they really kicking themselves because they're not making that extra profit? They're still selling it at 53.
Right.
And pumping it at 52. And guaranteeing they survive, but they're not guaranteeing they're getting rich. And they would be if they were selling it at 75. And so, the question is, would they essentially cover their shorts into that strength because they'd get greedy and kill the hedges? And so the question, but we don't know. We don't know where they stand now. So as oil goes back down below that level, the question is, are they still holding those hedges? Because if they are, they can continue to pump unrestrained, and they're still making a profit. But if they sold the hedges, or if they covered the hedges, when oil was higher, then they would need to shut down production now because they've already gotten out of those positions. So the oil they pump now, they would be selling at a loss.
Under this,
see what I'm saying?
Yeah, no, I get what you're saying. I suppose the question I'd have is if they are doing this, wouldn't there be a little bit more stability around their earnings rather than the fluctuations that we see?
You mean if they have held the hedges?
If they've held the hedges, correct.
Yeah, I suppose so, although I don't know what types of maneuvers happen in their accounting and what they present and what the timing is. But that's a perfectly valid point. So if because of the volatility that we've seen in earnings over time suggests that they've sold the hedges, although if they're hedged out to 2023, I suppose they could sell the oil that they pump at a profit, keep the hedges, and essentially meter out the forward sales with new production when the price declines. I'm not really sure about that. But you may be right. You may be right that that's a sign that they have gotten rid of the hedges, which means perhaps what we're seeing right now is the beginning of the market realizing that. And if they are in a situation where they're going to start to reduce production, and at the same time the Saudis are going to try to reduce production. So in other words, the price is actually tempering the level of production that comes from shale producers, and at the same time the Saudis are reducing production, then you get yourself a bottom in oil, and that would make sense. That would make a lot of sense. I wasn't necessarily saying I know they've got the hedges. I was saying the important question is whether or not they have the hedges.
Right.
So that's the way I've looked at this market. The reason why I've kind of held off of just barreling in when it looks like it's oversold and it's below the cost of production is there's that lingering question out there, and we haven't really gotten confirmation on that. And it is possible that we will get some conversation around that, some discussion around that in conference calls with earnings season.
Yeah, I was just going to say, I'm assuming that that's going to be a key item that you're going to be watching around earnings season for this group in particular. Certainly for the banks, such as a Comerica or a Cullen Frost, that's some of the things I'll be looking at in terms of just keeping an eye out on commentary around credit costs, particularly in that energy space with that drop in oil, similar to what we saw back in 2015, right?
Yeah, exactly right. And everything there was about redeterminations as well.
Yeah, which would be in March, correct?
I think early April.
Is it
I
April
think
and
it's a span of
October?
time. I think it is.
Okay.
Yes.
I know it's definitely October, so April would make sense, right, for the...
Yeah.
So, all right. Well, Brett, you got anything else to add in at this point? I know this is a good entry to 2019 on the first trading day of the year for everybody. You got anything else that you want to add at this point?
I mean, basically, from a trading standpoint, again, the last couple of weeks were really spectacular, and we're starting off with a new year. And again, you can almost think of it as a new team is on the field, and you have to get to know the situation. It's not a contiguous relationship with what we saw to close out last year. Money managers are going to handle things differently. We've got now another full year before it's bonus time, before the report cards are turned in. People are going to behave differently. Where taxes are concerned, there's different considerations. So the market is a new market. And so far, it's acting completely different from the market we saw last year. And not just directionally, the fact that we're rallying, but the actual tone of the tape, the robustness on the side of the bid, the fact that it can't be cracked down very easily. And even though we have a volatile day on our hands in nominal terms, in terms of total daily range, the intraday movement and the way the tape feels doesn't feel like a very volatile market to me. It feels like it's clawing back space and it's a grinding move, and we're seeing small patterns with occasional bursts, and I think those bursts are really related to traders gradually trying to fade this bounce and gradually giving up because they're fading it into a bit of a steamroller of a bid. And it's going to be interesting to see how over the next couple of days that pattern evolves. But right now, it looks like a lot of new money is coming into the market, and I would suggest that it's going to be more of a buy the dip situation early on. And I'll let you know if I change my view on that, but that's what I see so far.
All right, good stuff. All right, Brett, well, we'll be talking to you and looking for your commentary over the next few days, that's for sure. And good talking to you again in 2019, my man.
All right, thanks, Gav.
Okay, take care.